Listen to me, because if you are approaching retirement or you're already retired and still bringing in a great income, whether through consulting, a late career surge, or business revenue, you have a big target on your back when it comes to taxes. You have worked your entire life to build your nest egg, and your biggest fear right now isn't just market volatility. It's hand-delivering a massive chunk of your hard-earned wealth to Uncle Sam every single year. You want your money sitting in a tax-free basket where it can grow and stay protected for the rest of your life. So you hear about this famous strategy called the Backdoor Roth, and your eyes light up. You think, Susie, this sounds like the holy grail. I make too much money for a regular Roth IRA, so I'm just going to use the backdoor and make all my future withdrawals completely tax-free.
Hold on.
Stop right there. I need you to pause and listen to every single word I am about to say, because if you do this wrong, you are walking straight into a tax nightmare that can cost you thousands upon thousands of dollars. Let's break down the problem first, so you understand why you're blocked. The IRS puts strict income limits on who can contribute directly to a Roth IRA. If you're married filing jointly or filing single with a high income, the IRS looks at you and says, "Sorry, you earn too much." The front door to a Roth IRA is locked. That hurts, because as you prepare for retirement, having tax-free income from a Roth IRA is pure gold. It doesn't trigger higher Medicare Part B or Part D premiums. It doesn't push you into higher tax brackets, and unlike traditional IRAs, Roth IRAs don't have required minimum distributions during your lifetime. So how does the backdoor Roth work? In theory, it sounds simple. There is no income limit on who can contribute to a traditional IRA, though you can't deduct that contribution on your taxes if your income is high. And there is no income limit on converting a traditional IRA into a Roth IRA. So the strategy is, Step 1, you put after-tax money into a traditional IRA as a non-deductible contribution. Step 2, you immediately convert those funds into a Roth IRA.
Boom.
You went through the back door. Now, here's the question you must ask yourself before you move a single dime. Do I have any other pre-tax money sitting in any traditional IRA, SEP IRA, or simple IRA? This is where people get burned, and it makes my heart ache because it is completely avoidable. There is a little-known IRS rule called the Pro-Rata Rule. The IRS does not let you isolate just that fresh after-tax contribution you just made. Instead, the IRS looks at all of your traditional, SV, and simple IRAs combined as one big pot of money on December 31st of the year you do the conversion. Imagine you have a giant pitcher of coffee, which represents $100,000 of pre-tax money sitting in an old rollover IRA from a previous job. You take a tiny tablespoon of cream, your $7,000 or $8,000 after-tax backdoor contribution, and you dump it into that pitcher. You can't reach in with a spoon and scoop out only the cream. When you pour money out into your Roth IRA, you are getting a mixture of coffee and cream. That means the IRS will tax your conversion proportionally based on the percentage of pre-tax money across all your IRAs. Suddenly, what you thought was a zero-tax conversion turns into a massive, unexpected tax bill on ordinary income right when you are trying to simplify your finances for retirement. So, what is your actionable takeaway right now? First, take inventory of every IRA account you own. If you have zero pre-tax dollars in any traditional, SP, or simple IRAs, the backdoor Roth is a clean, beautiful strategy. You make your non-deductible contribution, convert it immediately before it earns interest, file IRS Form 8606 to track your after-tax basis, and enjoy your tax-free growth. Second, if you have large pre-tax IRA balances and you are still working or have access to a current employer's 401k or 403b, check if that plan allows a reverse rollover. You can roll your pre-tax IRA money directly into your employer's 401k.
Why?
Because 401k balances do not count toward the IRA Pro-Rata Rule calculation. Once your IRAs are cleaned out and sitting at a zero pre-tax balance, your backdoor is wide open and clear. Third, if you cannot clear out your pre-tax IRAs, do not force a backdoor Roth without speaking to a qualified tax professional first. In many cases, doing standard taxable account investing or executing strategic, intentional Roth conversions in lower-income retirement years will serve you so much better without triggering a tax trap today. Stand to your truth. Protect your retirement nest egg. And never make a financial move just because it sounds fancy until you know the exact tax rules behind it. You can do this, but you must do it smart.